Hello everyone, this is Mark with Semantics Research with the Daily Report. If we were to take a look at the markets today, the ES was pretty much range bound with no proper direction, and it was quite a choppy market. We did take out the previous day's low, and we made new lows, but we failed to auction lower, so we held mostly inside of the previous day's range. Meanwhile, the VIX remains elevated in the 30s, going into options expiration today, and it will be very interesting to see how players position themselves into the next week. The dollar did bid slightly higher today, and the Treasury bonds are still a bit bid as yields have come up quite fast this past week, and now we're seeing a pullback in the yields. Now, going into the 10-year real yields, we have seen the 10-year real yields rising, which is considered the benchmark for borrowing costs. And this 10-year real yields have gone up 150 basis points in the last 2 months as the Fed gets more hawkish. Now, going into the real yield, it is calculated by adjusting nominal yield versus inflation. Real yields have gone negative for 2 years, which provided a great environment for risk assets, but the climb above zero into positive made equity valuations lower due to higher borrowing costs. When real rates rise, it makes the non-money making companies drop in valuation due to opportunity costs for investors to hold them. It also lowers stock valuations by reducing the present value of corporate earnings ahead, especially companies that are long duration or those that will generate cash flow in the future and make bonds a more competitive asset class in relation. Real 10-year rates is about 0.88%. compared to negative 1.25% 7 months ago. This was due to last week's inflation report, which surged higher rate hike odds and pushed Treasury yields higher. Having lower borrowing costs in a negative real yields environment has allowed low quality tech and growth to soar. So when you have QE, negative TIPS yield, inflation higher than treasuries, and CPI not out of control, it is very bullish for a risk-on trade. The reason is because if inflation is higher than the yield, it is not profitable to buy low return bonds or equities. Right now is the opposite, as bonds are looking better than stocks, and it seems like at the current moment it's value investing that is in favor over growth. So you could say that the TIPS yield is one of the best indicators, and right now it is signaling that bond yields are too high currently compared to inflation. So people should buy bonds over stocks, and also it's going to be an environment where it is expensive to borrow since the TIPS are high and the yields are high. So investing in companies with low present value, which means these companies are expecting higher value in the future because they're not making money at the current moment, but they expect to make money later on. So they're basically profitless, high growth companies, usually tech and discretionary. They are losing a lot of money in the short term due to higher interest rates. And if you're borrowing, it's going to eat away into your profits, and there's also an opportunity cost to invest in these names. So this is why you see a lot of growth in tech names being very weak as of late. Now, if we go into the industrial production numbers, we are up slightly by 0.2% month over month, which was a miss of the analyst estimates. U.S. manufacturing output actually contracted in May, and utilities and mining rose 1% month over month and 1.3% month over month, respectively. So we're seeing a bit of contraction in industrial production, which is not ideal. So going into the numbers, we do see that most of the major groups like consumer goods, business equipment, construction supplies, business supplies, and materials all posted increases of less than 0.5%. So we are seeing some weakness there. Let's see. Going into oil, the European Union has cut off oil imports from Russia, but Hungary still receives Russian oil through the pipelines. OPEC is not at full capacity, but it does not have much room to increase supply, and it is at a slow pace of rebuilding production after the pandemic. There is potential for U.S. shale to be a key producer in this time, but it's not likely due to the administration's restrictive policies and fears of being burned. Also, input costs are much higher since the pandemic, as materials are way more expensive and skilled crews are in very short supply, so the labor market is very tight right now. It is likely that we will see oil sustain higher prices, but there is resistance to higher prices from here due to the futures oil curve being in backwardation, where the 2-year out price is trading at about a 30% discount to the current spot price. While backwardation should not be interpreted as market traders thinking the price cannot go higher, but rather the oil produced from a shale oil well today may command a much lower price than today's spot price, so it makes managing revenue flow very complex and challenging. Some copper traders have been seeing some elevated risk for copper, and copper options are currently have a mildly negative skew, with out-of-the-money puts costing more than out-of-the-money calls for early June. We have seen a surge in copper prices in the last 2 years due to global manufacturing booming after the reopening of the economy. Consumers have shifted spending to durable goods at this time, and stimulus also boosted consumer demand as well as we reopened. Now, if we take a look at the copper prices, we do see that it is moving sideways, and you generally see volatility die when it consolidates. But if you take a look at the options pricing for copper, it is not the case, as it seems like options traders are seeing market risk in copper. Perhaps they are thinking that consumers will shift spending away from durable goods back into services, which will impact demand for copper, as well as higher mortgage rates impacting housing construction, as on average, a home contains about 220 pounds of copper. Also, with slower growth or even recession looming, we could see demand drop off in copper. So there are some factors that could weigh into the downside for copper price. Now, according to Redfin, we are seeing less buyer demand in the housing market due to surging mortgage rates and the home prices being high. Although supply remains tight due to home builders building less homes, we will likely see prices start to drop off due to lower demand and a possible recession. And that is it for today's daily report. I thank you all for watching, and be sure to check out the link in the description for more updates. Thanks again.